Inflation is moderating, and the markets are telling us the Fed is about ready to start cutting aggressively. If you're a buyer, borrower, or real estate professional, join us today. We're going to go through what happened this week, how it impacted interest rates, and what's likely to come next. We always start with the charts to see exactly what happened this week. What you'll see here is not a whole heck of a lot. Monday, Tuesday, Wednesday, you see those yellow lines. 10-year Treasury, flat. Mortgage-backed securities, flat. Now, remember, with the 10-year Treasury, we want to see yields dropping. That's the actual cost of money. With mortgage-backed securities, we want to see the prices paid for bonds increasing because that is rates dropping. If you notice, these charts are almost the polar opposites of each other. We watch the 10-year because mortgage-backed securities never get all that far away from the action in the 10-year. And what you can see, Monday, Tuesday, Wednesday, not a whole lot. Then on Wednesday, we got that CPI data, which was much better than expected, and we saw this nice drop. We had a bad auction yesterday, gave back a little bit of that, and then ended up near the best levels of the week. 10-year yields were down 0.11% for the week. Mortgage-backed securities were up about the same amount, 0.65 basis points or 65 basis points, which is also about 1/8% in interest rate. Mortgages actually performed a little bit better, which is a sign that the 10-year and mortgage rates are narrowing a little bit, although still historically large on those spreads. So why did rates improve? We looked at that chart. Not a whole lot happened early in the week because we didn't have a whole lot of data to trade off of. No real market moving data on Monday. Powell had his semi-annual testimony ahead of Congress on Tuesday and Wednesday. On Wednesday, we had a 10-year note auction that actually went off really well. Grade was like a B+, meaning that was a positive for mortgage rates and Treasury bond. Yesterday was when we saw all of that price action, which was due to the consumer price index. The core was down to 3% from 3.3. Month over month, we actually saw deflation. Core prices were down 0.1% month over month. The headline went from 3.4 down to 3.3 and was only up 0.1% a month. You can't really annualize over the course of a year, but that would tell us inflation's at 1.2% currently if we saw 3, 6, 9, 12 months of that. So definitely the market is believing that what we saw early in the year was an aberration, was sort of stalling out in the lowering of the rate of inflation, and we are back on track. Now today, we did get some interesting information. PPI, the producer price index, historically more volatile index and doesn't correlate directly over to consumer prices, but can be indicative of it, came out really, really hot. We were 0.2 month over month versus 0.1 expected, but more importantly, last month was revised up to 0 from deflation there of -2%. So again, this is more volatile. The market dismissed it. The components, the subcomponents of PPI that trickle over into PCE, the Fed's preferred measure, those were actually benign. The hot components in PPI don't really trickle into PCE. So the market, at least for today, overlooked that hot PPI data and continued improving. So why was the consumer price index better? This is the one we've been looking for the better part of a year. We all know that those super hot shelter costs, home prices going up, rents going up at record levels, that was primarily during the pandemic, and while still elevated, have moderated so much, but we have not yet seen that trickle into the CPI and PCE data. So shelter costs are 45% of the CPI index. They averaged 0.2% in June. And over the last year, it's been about 0.45% month over month. So finally, again, seeing reduced shelter costs trickle into CPI. That should continue going forward. We want to see 2 or 3 months of it before concluding that. But if we continue to see those numbers, CPI is going to rapidly progress down to the Fed's preferred measure, preferred number of around 2%. Most real-time reports on rent show 3% annual inflation, or about 0.25% a month. So a little hotter than what we see in this month's CPI data. But if that actually reflects in CPI going forward, we're definitely going to see the Fed with some cover for cutting rates. We had a quote last week from Chicago Fed President Austin Goolsbee. We have another quote this week reiterating more information, but actually more positively towards cuts in the near-term future. He said the committee put out a statement saying we would not anticipate cutting rates until we were more convinced we're on a path to 2%. My view is this is what the path to 2% looks like. And then he followed up with the shelter reading was profoundly encouraging. So it tells us that's exactly what they're looking at. CPI, inflation, moderating, led by shelter costs. Mary Daly, the San Francisco Fed president, says, with the information we've received today, which includes data on employment, inflation, GDP growth, and the outlook for the economy, I see it as likely that some policy adjustments will be warranted. So definitely Fed members giving indication, although not telling us the timing, they're telling us that they do expect to be cutting soon. So what did the headline say? So economists, journalists, writers, they're saying here, the Washington Post, inflation eased further in June, helping to cement the path to rate cuts. Bloomberg, U.S. inflation broadly cools, likely sealing deal for rate cuts. CNBC, key inflation report looms on Thursday as traders grow more confident in a rate cut. And the Wall Street Journal, milder inflation opens door wider to September rate cut. And a few others there, but you get the point. The economists and journalists are expecting that we're going to see Fed cuts in the near future. One of my preferred experts, David Rosenberg, had some pretty important commentary in his daily newsletter. And he said, I do think we will see rate cuts at September, November, and December meetings, but whether the Fed goes 50 basis points at one or two of these is the more important question to him. That's pretty aggressive, but he's saying 75 basis points by the end of the year, maybe as many as 100 or 125 if we saw some 50 basis point cuts. He also said what is important is the destination, and it's 2% for the federal funds rate. This is important because the markets are priced for a 4% terminal rate. I come to this conclusion by the pattern of the historical record. The Fed always brings the Fed funds rate to or below the 5-year average when the easing cycle commences, with or without a recession. The average of the past 5 years is 2.2%. The current rate is 5.3%. Not since the spring of 1982 has the gap been this wide, and it will close if the past is prescient. So again, that's one expert. David Rosenberg is awesome. There are others who don't necessarily agree with him, but that is one slice of data and input. So what are actual bettors, investors in the futures market saying? They're saying still no cut for July, one cut for September, two cuts by December. So whether that comes in November or December, the markets are projecting two cuts. If we look, this is the aggregated probabilities per the CME FedWatch tool. So it says we got a 99% chance of seeing that cut in September, 62% chance of two cuts by November, and a 51% chance of three cuts by December and 73% by January. So they're projecting out there is that 1, 2, 3, 4, 5 cuts by June of next year as 100% probability. Now, remember, this is a nowcast. We saw very, very similar numbers in December. And as the data went the other direction, January, February, March, we saw those probabilities change drastically. So this isn't a crystal ball. No one has it, but it is what investors in the futures markets are seeing right now. So as always, we want to look at, this is a chart of the 10-year. We exited about a month and a half ago, this red up channel in yields, and we are firmly in this down channel. As we talked about last week, we had hit the top of that channel and we are making a run towards the bottom. Today, we are at an important level. 4.19 is the next level of resistance that we have to get below. And if we get through that, then we'll make a run even lower, all the way down to about 4.7 would be the next layer of resistance we would hit. So that's 4.19. We closed at 4.187. We need some impetus, some data to push us lower, but we're in this channel. It is moving downwards. We haven't gone all the way to the bottom of that channel. It's looking really likely that we will get to 407, which would be about another eighth lower in mortgage rates. So let's look at what happens next week. So on Monday, we have another Powell speech. Tuesday, we have retail sales. Those are both important market movers. Wednesday, a 20-year bond auction that can move the market. Thursday, a 10-year note auction can absolutely move the market. And then Thursday and Friday, lots of Fed speakers out. So what they say and how they react to the data that we've seen over the last couple of weeks, the June jobs report, the PCE data, the CPI data is going to dictate where the market trades going forward. So what does that mean? Mortgage News Daily, as of today, is reporting 6.82 on a 30-year fixed. For well-qualified borrowers with decent-sized down payments, you're going to be able to do better than that. Lower credit scores, 3% down, maybe slightly higher than that. FHA and VA, they report 6.25. We're at that 6, possibly even below 6 for the most well-qualified borrowers, but this is a very good number to look at. I wanted to highlight here, over the week, you saw we really should have only improved about an eighth. And if you look here, we were almost 0.25% if you average out those changes. And we are nearing the 52-week low. We're within about 0.25% of the 52-week low. And if we get all the way down to that 407 on the 10-year or lower than the 407, we're going to see the lowest interest rates in the year. So if you've watched this far, hopefully you found the information helpful. If you have questions, you want to quote, you want to get started on your mortgage, you can reach me at josh@bywisemortgage.com. All of my contact info is in the description below. I am Josh Lewis, a certified mortgage consultant with over 29 years of experience in the industry, and I would love to help you. Thanks for joining us. We'll see you next week.